Good day. Welcome to another lesson on our Super Dealmaker Entrepreneurship Master Program. We're still looking at the skills program business finance, and today's lesson will be looking at the module cash flow management. Maybe just to recap, we started with looking at the financial statements in general, and we looked at bookkeeping, we looked at income statement, we looked at balance sheet. So now today we're going to look at the cash flow. A cash flow statement is more or less a derivative statement, meaning it derives its information from both the balance sheet and the income statement. So you need to have a basic understanding of the income statement and the balance sheet for you to understand what is the cash flow and how to read the cash flow. And with the cash flow, okay, so I guess even for me, when I was doing finance, it was the most difficult statement to balance because my cash flow was never balancing. But it's because of I was missing the concept. Of what is an income statement, what is a balance sheet. But once I got the concept and understood what is a income statement, what is a balance sheet, and their functions, then it made it easier for me to be able to draft a cash flow statement that is balancing. What is cash flow? Cash flow is a statement that shows how the organization is performing cash-wise. So remember when you spoke about the income statement, I gave you the example of a report card from your child. When your child go to school over a period of a year, end of the year, he comes home with a report pass. Either you passed or you failed. Either you made profit or you made a loss when it comes to the financial. So the income statement assesses the performance of the organization. And remember when you spoke about the balance sheet, I said the balance sheet is like your health check. When you're going for a checkup, to check your annual checkup, whatever, the doctor's checkup, they check your high blood, sugar levels, and all those things. That's normal checks that the doctor will do when you go for checkups. That's your balance sheet. So the cash flow combines these two to see your position, if you are doing well in terms of performance-wise and position-wise. So you look at both of them to say, are you in a good, are you performing well? And the position, let's say position in the log. Where are you in the log in terms of performance? Okay, so you are performing and you have two positions to say, maybe you are doing well on the log in terms of the health of the business, and daily you are performing well. But in combination, ultimately, where are you? Are you making money or not? So the cash flow will show you, the bottom line is the cash. Where are you spending your cash? Remember, the income statement is more, I'll call it theoretical in a way that it also includes non-cash items like your depreciation. Remember, I was talking about depreciation when you're doing the income statement. So when it comes to cash flow gets rid of those to say, I don't want to see what is not cash. Remember in business they say cash is king. Yeah, so cash flow is king. It eliminates the non-cash items that you'll have in your income statement, and now it combines it with your balance sheet to see how are you doing cash-wise. That is the cash flow in short. And then what it does, it shows how liquid the business is. It monitors your cash. You can do your cash flow on a monthly basis, annually, or when you're doing your financial statements. That's the cash flow. But most businesses, to monitor how they are doing, they will use the cash flow statement to see where they are. So it shows the liquidity. Remember when I was talking about the balance sheet, we spoke about solvency, where I said if your assets or if your liabilities exceeds your assets in the business, you are technically insolvent as a business, right? That's insolvency. And with cash flow, it shows liquidity. How liquid are you in terms of the actual fund, the actual cash in the business? So a cash flow is one of the key statements that as an entrepreneur or as a financial manager, you should be able to read, interpret, and present. And I know that I said it's a little bit difficult statement, but it's a very, very important statement when it comes to financial reporting. So this lesson, please, I know finance sometimes it can be dry, but you need to focus and make sure that you understand what is the cash flow, how you're going to use it in business, so that when you're looking at the businesses, you can, one, when you're evaluating your business to see how your business is performing, then you'll be able to see from the cash flow side. And as well, if you're reading, maybe you're investing or you're interested in another business, you can look at their cash flow to assess how are they performing when it comes to cash flow. How is the cash moving? Because they might be making revenue but not collecting the cash. Okay. Or they might be collecting the cash, making revenue, but find that they have high debts that they are repaying, and that will have negative impact on your cash flow. So let's say the income statement and the balance sheet can tell you maybe one side of the information. Then with the cash flow, it tells both sides of the story. Okay, I wouldn't say maybe it's telling is the statement that tells the truth, but what I'm saying is it tells you both on the performance and on the position side. It combines the two. So it gives you a better understanding of your business when it comes to, is it your business liquid? Is your business actually generating money? Because cash flow is focused on how you generate your cash. Okay, as you can see, the cash flow on the side, we'll be going through each item on the cash flow, explaining it and telling you what does it mean, so that when you see these items, they can mean something to you as an entrepreneur. Because sometimes you just see these things, but you don't understand what does it mean. So how you prepare a cash flow, you start with the income that you receive, which is the net income from your income statement, the bottom line from your income statement. Then once you get the bottom line from the income statement, then you need to adjust it for the non-cash items like your depreciation and your interest, because your interests are not operational. So the first part of the cash flow, it wants to see the income that you're generating from your operations, which is a cash flow from operating activities. So your cash flow from operating activities, it shows you how much you have generated from your operating activities. Now, from the cash flow from operating activity it's supposed to be made up of your net profit, but you add back the depreciation, because a depreciation it's a theoretical figure. It's not necessarily the money that you spent, but it's the money that you provided for. You made an adjustment, if you can call it that. And then you add back the interest if you paid interest, because interest is not an operating expense. It's more of an investment expense, okay, or a financing expense. So they take it out. Then once you take those two out of your net profit, then you remain with the profit from operations. So when you have the income from operations, then you need to adjust for your current assets. Remember, when you're looking at the balance sheet, we had our current assets, we had our current liabilities. So you need to, as I mentioned before, that when you look at the cash flow, you should have clearer understanding of your income statement and balance sheet. So if you haven't gone through those two lessons, I suggest that you go through those lessons before you even attempt to go through to understand this lesson, because it gets a little bit complicated if you don't have the basics from your income statement and balance sheet statement. If you don't understand them, then you might struggle to follow, because as I said, it combines the two statements. So it's important that you do the first two to make sure that you have a grasp of what are those statements and their intention. Why do you have to have those two statements? All right. So I was talking about the current assets and liabilities. So when it comes to the movement, because in that, right, you are looking at the movement between the previous year and the current year. So with the cash flow, you will have, okay, in the balance sheet, you'll have the current assets, and which from the previous year, and the current asset from the current year, meaning you will have two balances. So with the assets, is that when your assets increase, you will be spending money. Okay. So if you have now more laptops in your business, that means you have spent money. Okay. If your liabilities increase, it means money came into your business. Remember, a liability is the money that comes into the business. It's the money that you borrow from external sources. So it means money came into the business. Similarly, if the equity increases, that means money is coming into your business. Okay. Now, going back to the balance sheet lesson, remember I was emphasizing to say you need to understand the basic principle of accounting, which is owner's equity, which is accounting equation, which says the assets are equals to owner's equity plus liabilities. So those two sides, your assets must always be equal to your owner's equity and your liabilities. So when the asset increases, that means you are adding on the asset. That means you are spending money. If the liabilities and the owner's equity increases, that means you are taking money out, or the money is coming into the business. That means you are borrowing money. So maybe let me just repeat that. When your asset increases, that means you are taking out money to buy those assets. So the money is going out of the business, right? And when your liabilities and your owner's equity increases, it means money is coming in. So I'll give example to say the liabilities increase because you sold stuff to customers on credit. The money is coming in. It's just that you are not getting the money now. You'll get the money later. But the concept is that the money is coming in. So you must keep this principle. So you need to understand the accounting equation, which is asset equals to liabilities plus owner's equity. Then you need to understand that when your assets increase, that means the money is going out. When your assets decrease, that means the money is coming in. So your asset will decrease because you are selling the assets to whoever that you are selling to. Then the money will come in. Right. With the liabilities, when the liabilities increase, it means you are getting the money because somebody is owing you. So the money is coming in. When your owner's equity increase, that means the money is coming into the business. And then when your liabilities decrease, that means you are paying money, so you are losing money. When your owner's equity decrease, then also it means you are paying money. The money is leaving the business. So those are the two principles that you need to understand. Like I ask you to understand the asset equals to liabilities plus owner's equity. Now you need to understand the concept of increasing assets is a decrease in cash. A decrease in assets is an increase in cash. On the left side of the accounting equation. On the right hand side, the increase in liabilities is an increase in cash. The decrease in liabilities is payments, is the decrease in cash. So money is going out. Same thing with owner's equity. An increase in owner's equity or the equity that you have in the business, the money is coming in. Your equity is growing. And the decrease in equity is money going out of the business. So when you're reading the cash flow or when you're preparing the cash flow, this is the basic principle that you need to understand, because otherwise you'll never get it right. You'll never get the picture of the cash flow, how the cash flow works. So if you can understand this principle, if you have to repeat this video to understand what is cash outflow and cash inflow, why this one is negative, this one is positive. This is the principle. This is the premise of your preparation of the cash flow. Okay. So now that I've explained the principle, then I'll go back to the cash flow. Remember where I left off before I went on this off-ramp of explaining how the money comes in and goes out of the business. I was at the level where we're still calculating the cash flow from operating activities, which is the cash flow that comes from your operations, right? We said the first, for the period that you are reporting for, let's say it's a 12 months period you are reporting for the annual, then you look at the beginning of the year and the end of the year. That's how the cash flow works. So in the income statement, obviously income statement is the report card for the year. So you just take the amounts at the end of the year or at the period that you are reporting for. Your net profit is at that period. Your depreciation, it will be at the end of the period. So you're adding all the amounts for that period. So as the figures in the income statement, when you're doing the cash flow, the income statement figures, you take them as they are. If I'm referring to, you see the depreciation, you know it's coming from the income statement, but you must take it as it is. You know that it's not a non-cash item, so you need to take it out. If you have interest, you take it as it is from your income statement and put it in your cash flow where you're supposed to put it. But when it comes to the balance sheet amount, this is important. The difference, how you treat the income statement amount and the balance sheet amount in your cash flow. You take the difference. Okay. There will be a difference between the opening balance or the closing balance from the previous year and the closing balance for the current financial year or the current period. You take the movement between the two, right? So if it's the current liabilities, you're going to take the balance at the beginning of the year or the closing balance from the previous year, you minus the closing balance for the current year. You take those differences. You know what is your movement. Wherever you're using those figures. So generally what I will do when I'm preparing the cash flow, I take the figures that I know I'm going to need from the income statement. So I'll take the net profit. I'll take the depreciation. I'll take the interest. Then I'll take any other non-cash item, if there is any other non-cash item. And then I'll take proceeds from disposal of assets and other liabilities, whatever. If I disposed anything, then I take those figures as they are from the income statement. Okay, put them one side. Then you take the movement from the figures in the balance sheet, meaning you look at your previous year's balance sheet and the current year balance sheet, or the previous period's balance sheet and the current year's balance sheet. Then you take the difference between the two. So you're going to take the difference between the assets, between the liabilities, between the owner's equity individually. So that when you're preparing the income statement, you'll have the figures, you'll know which figures you are using. Okay, so that's how you look at it when you're doing preparing the cash flow statement. All right. So now going back to your operating activities. So because I keep on going back to operating activities and going back to how you do things, because I'm trying to teach you the principle how these things are prepared, right? So now when you get back to the cash flow under operating expenses, operating activities, you take your net profit as it is from the income statement. You add back the depreciation. you add back the interest, right? Then you're going to get your proper operating cash flow. Then you adjust those with your current liabilities, right? Current liabilities is your trade creditors and other creditors. So what you're going to do when you look at the current liabilities, you take the balance at the beginning of the year and the difference between the balance at the beginning of the year and the balance at the end of the year. You take the difference. And then, but you know that if the balance at the beginning of the year is more than the balance at the end of the year, that means you paid some creditors. So you need to know that you paid the creditors, and when you pay the creditors, that means the money is flowing out of the business. So if you look at the balance of your creditors at the beginning of the year and at the end of the year, if the one at the beginning of the year was higher and the one at the end of the year was lower, that means the money was flowing out of the business. But if your current liabilities at the beginning of the year or from the previous year is lower and the current one is higher, it means the money was coming into the business. So the money was flowing into the business. It goes back to that principle you need to keep in mind to say your liabilities, if your liabilities are increasing, then the money is going out of your business. So with the current liabilities, depending on your accounts payable, if your accounts payable balance now is more than the accounts payable balance from the previous reporting period, then that is the cash inflow because your liabilities are higher. If it's the opposite, that is the cash outflow. So you put that under the movement in your current liabilities. Then you're going to have the movement in your current assets. Okay, current assets, you're looking at your debtors, meaning your prepaid and your trade debtors. If your trade debtors are increasing, remember the assets are increasing when your assets are increasing, then the money is flowing out of the business. And when your assets are decreasing, that means the money is coming in the business. So when you take your accounts receivables, which is your debtors and your prepayments, if the money from the previous financial year is higher than the money in the current financial year, then you know that there is an income because you had high assets and currently you have lower assets. Then the money came into the business. That means you collected on the money that you've been owed. But if your current assets are lower and currently the current assets are higher, that means the money was flowing out of the business. So that is a negative when it comes to the cash flow. So you need to have this concept right to say, how does the money flow out of the business when it comes to the assets and liabilities? It must be clear on that one. So now, depending on the movement, then you put your current assets in the movement. If it's an increase if the money is going out, you put it as a negative. If the money is coming in, you put it as a positive. So you're going to do your current liabilities, you're going to do your current assets, you're going to do the same as stock. Remember, your stock inventory is also an asset. So if your inventory balance from the last reporting period to the current reporting period is increasing, it means you are producing stock that you are not selling. So you are spending money to produce that stock, but you are not selling the stock. It means the money is going out of the business. So the ideal is, obviously, if the business is growing, that will happen. The stock from the previous year will always be less than the stock in the current year because you'll be growing the business, keeping more stock. But you must know that if your stock or your inventory is increasing, then that means that you're spending money. The money is going out of the business. I always say stock is money. So as a business, you must always make sure that you manage your stock efficiently because keeping stock is not flex. It's not a sign that you have a good business. Good business must keep minimal stock. So the higher the stock figure, the higher the amount that is going out of the business. So you need to make sure that you balance your stock with your customer demands. So even when you're doing the cash flow, same story, same interpretation you need to use. To say, if your stock amount in the previous reporting period is lower than the current balance, then the money is going out of the business. And you record it as such when you're preparing your income statement. Remember, now you're going to calculate the cash flow from operating activities. So the cash flow from operating activities will be your net profit or your net loss if you are making a loss. Then you add back the depreciation, you add back the interest, then you add or minus your movement in your current assets, depending on how your business is doing. If you have a cash outflow from your current assets, you minus it. If you have a inflow, you add it. Similar with your liabilities, current liabilities. If you have the increase in your creditors, which is cash inflow, then you add it. If otherwise, you minus it. So that is how you calculate your cash from operating activities. So that is the figure that you'll see in the cash flow if they say cash from operating activities. Operating activities, because those now shows the liquidity of the business in terms of the cash movement. Are you making money from the income statement side? And in terms of the current assets, do your current assets exceed your current liabilities? If not, then you might have a problem, because you will have money tied in your current assets rather than in money coming in from your current liabilities. So that is your cash from the difference then will give you the cash from operating activities. And the cash from operating activities, it shows you that operationally, how are you doing? Are you making money from your operations? If you have a positive cash balance at the end of the year, it depends. Is the cash coming from your operating activities, or is coming from maybe investment activities, or you're from your financing activities, meaning you're borrowing money to run the business, or you're using the assets, you're selling the assets, you're losing value on the assets, you're making money from losing the assets, which is not a good thing. So the cash flow from operating activities becomes very, very important. You need to understand how to calculate it. And the cash flow shows you if you are making money from operating activities. Because you are, as a business, you're supposed to make money from your operating activities. Otherwise, you are in trouble if you're not making money from your operating activities. Because if you are making money from any other things, like if you have a negative operating income, or you're losing money from your operating activities, that means as a business you are losing money. It means you are not operationally sustainable. So it might happen in a year or whatever. There's certain things that happens where maybe you write off stock, or certain things you're not performing, or you're still growing, or you're a startup. Remember, the startup, it makes losses, but you need to get a point where it's stabilizing. Only if there is an extraordinary item in your operating activities, or maybe you are a startup, you're still building up your business. Only then you can have a negative operating cash flow from operating activities. But if you have a negative cash flow from operating activities while you don't have any extraordinary item, or you are not a startup, then you might be in trouble. But remember, there are certain cases, maybe exceptional cases, but in most cases, it will mean that your business is in trouble. So the cash flow from operating activities is very, very important indicator of how your business is doing. So that is our cash flow from operating activities. And as I said, that is the key figure that you need to make sure that it's improving over time. Because if you're not making money from your operations, then you have a problem. So now we're going to look at the cash flow from investment activities. So what is the cash flow from investment activities? So this is a cash flow from your assets, your long-term assets. Remember, we dealt with our current assets in the operating activities. So here we're looking at your long-term assets, meaning your PPE, property, plant and equipment, and your investments, your long-term investment, if you have investments as a business. So, and your cash flow from investing activities is the cash that you spend on those long-term assets, or the income that you make from the long-term assets. So in the cash flow from investment activities, we have your long-term assets. So should you buy assets, or should you increase your assets or your investment, it means the money is going out of the business. Remember, I said that when your assets increase, that means your cash decreases. That means the money is going out of the business. So when you look at the investment activities, you look at your equipment, property, plant and equipment, you look at your investment activities. So the more you invest in those, that means you're taking money out of the business. And if when those decrease, like when you sell them or you cash in on your investment, that means the money is coming in. It's reducing the money that's coming into the business. So just keep that concept. I know I explained it before, but it's critical that I continuously repeat it so that you understand what is cash flow from investment activities. So when you spend money on assets, or when you increase your assets, you must know that you are losing money. The money is going out of the business. Okay. When you dispose assets, or you reduce your assets, or when your investments mature, that means the money is coming into your business, right? But remember, with the assets, you still have that depreciation that you calculate when you're preparing the income statement, right? So when you're calculating a cash flow from investment activities, you must not take into account the depreciation, because the depreciation is money. It's not money, it's non-cash item. So what you do, remember, the assets are coming from your balance sheet, right? So you take the balance of that assets from the previous financial year, and you take the balance of your assets in the current financial year, right? You take the difference between the two. Let's say you're using the carrying amount. You use the amount in the balance sheet in the previous reporting period and the amount in the balance sheet in the current reporting period. You take the difference between the two. After you take the difference between the two, then you add back the depreciation for that year. Then, depending, if you have a positive figure, it means that the money is going out of the business. Meaning, if your balance from the previous year on your assets, it's more than the balance in the current year, then you must know that there was cash that came into the business. So because your current assets are less than your previous assets. So what you need to do is, once you get the difference between your current assets and your current assets and your previous assets, the balances, right? So you take your current asset minus the previous assets, then you add back the depreciation, right? So if when you're adding back the depreciation, your current asset, that figure is still positive, then you know that the money is coming into the business. So that means your assets have actually increased. Your assets have decreased in value. That means money came into the business. And here, remember, we are talking only the property, plant and equipment. Remember, we dealt with your current portion of your assets when you're dealing with cash from operating activity. So I'll repeat this. You have long-term assets, right, which is your property, plant, and equipment. You have a balance from the previous year, and you have the balance from the current year, right? Then you need to take the balance from the previous year, you minus the balance from the current year, right? So you're supposed to, if you do it that way, where you're taking the balance from the previous year, you minus the balance from the current year, you'll have a positive number, which is, you can have a positive number, which will generally, if you didn't buy anything, it will be your depreciation. So you need to minus the depreciation from that figure. But I mean, if you do it the other way, where you're taking the current balance, you minus the previous balance, then you add back the depreciation, depending which figure you're using first. It's very, very important, because you might be confused by this. So, but the principle that I use when I'm calculating the movement in my fixed asset, my long-term or my non-current assets, I take the balance from the previous year, I minus the balance from the current year, then I minus the depreciation. Okay, so it depending. If the number is positive, then I know I had a cash inflow from the current asset. If it's negative, I know that I have a cash outflow. So when I go into my cash flow, then I just minus that figure, which it makes it easier to calculate. But I'll show you in terms of how the calculation is supposed to be done, so that it makes it clear. It becomes a little bit more practical in terms of how you calculate your income from investment activity. Even for the investment, you do the same thing. Then you'll get your movement, then you're going to minus your movement from not minus, you add. If it's positive or if it's negative, you add it from your operating activities. That's how you do your investing activities. And the cash flow from financing activities, same principle. If your liabilities have increased, that means money came into the long term. Liabilities have increased, that means money came into the business. If your long-term liabilities decreased, then that means the money has left the business. So you record it as such in the cash flow, right? And then you're going to get to the cash movement. So your cash movement will be your cash from operating activities plus cash from investment activities plus cash from financing activities. It will give you the movement for that year or for that period. It might not be a year, it might be a month or whatever, depending on for the period that you're reporting for. Then it will give you the cash movement for that period. Then you add the cash from the previous year, the closing cash from the previous year, then that should give you the closing balance. And that closing balance in the cash flow, it must be the same as the closing balance in your balance sheet. That's where now the balancing thing comes in to say, if your cash closing balance or your cash closing balance in cash flow statement is not the same as the cash balance in your balance sheet, then there is something wrong. It means your financials are not prepared accordingly. So you need to go back and investigate where you might have made the mistake when you're calculating your cash flow. So the cash flow is a little bit of a difficult statement between, when you look at it, comparing the cash flow and the balance sheet is a little bit of a difficult statement to prepare, because you need a deeper understanding of your income statement and balance sheet, right? But remember, this is okay. I was just giving you the principle how you calculate your cash flow stuff, but you are not necessarily the accountant. I know even accountants are struggling to prepare the cash flow. Even people with, call it degrees, whatever, when it comes to the cash flow, they struggle. My cash flow doesn't balance. It's a familiar statement because it's a difficult thing, but it's because you need to understand the principle of preparing the income statement and the balance sheet. Now, maybe going into the important part, why are we preparing the cash flow? I explained when you started this lesson, we want to see the movement in cash. We want to see the real business performance. Because remember, as I said, the accounting principle that I use to prepare income statement and the balance sheet, but more importantly, the income statement, we use call it the accrual, and we use non-cash items like your depreciation. But the cash flow doesn't take that. The cash flow just wants its figures clean. No non-cash items, no funny things. So the cash flow gives you a clearer picture of how your business is performing when you're comparing it to the income statement. The income statement, it includes things that you are not supposed to. Not necessarily not supposed to, but it's not a practical one for entrepreneurs, most especially those who are not in accounting. So the cash flow is more on the management accounts because it takes us the theoretical stuff. It gives you the real cash. Are you generating cash or not? Or are you losing money? Are you generating cash from operating activities or from financing activities, meaning you are taking loans and all those things to sustain your business, or you are selling your assets? Because you can make money, but you find that you are selling assets, or you are taking loans. So with the cash flow, when you're looking at the cash flow will expose that. It will show your business if your business is making money from operating activities or is making money from financing, meaning you keep on borrowing for you to sustain your business, or you keep on selling your assets for you to sustain the business. So the difference between the income statement and the cash flow is that the cash flow removes the fancy filters. It removes the makeup. You see the person as the person, or you see the performance of the business without the filters, without funny things. It shows you cash. And they say cash is king. So with the cash flow, it clarifies things. It shows you where you're making money. Are you making money from your operations? Are you making money from your investment activities? Are you making money from financing activities? But you want to be making money from your operating activities, because that's why you are in business, to operate, to run a business. Yes, if you're a startup, it makes sense. You need to put in a lot of money into the startup for the startup to perform. Or if maybe there are certain things you are maybe doing refurbishment and all those things, you are refinancing growth. Because remember, the growing business, if your business is in the growth stage, it tends to chow money, it tends to swallow cash. Because you need to build things, you need to do marketing, you need to buy assets, you need to invest in certain things, processes, and all those things. So initially, it chow money, and then you lose money in that process. But you need to get to a point where the business will stabilize and perform the way it's supposed to perform. So that is the cash flow lesson. You need to make sure that you understand what you're looking at in terms of the component of the cash flow. Operating activities, it shows you the cash that is generated from operating activities. It shows you how well you're doing as a business. Cash flow from investment activities, it shows you how much you generate or you spend on investing in the business. If it's an income, that means you're losing money. It might be investments maturing or you selling the assets. But generally, you're not supposed to be making money from your investment activities. You're supposed to be making money from your operating activities. And if you are making money from your financing activities, that means you are borrowing to keep the business going. And it's not good for a business to be making money from financing activities. But as I said earlier, it could be because you are expanding. If you are expanding, then you need to be spending money. It makes sense that you are spending money from, or you get money from the financing activities, like from your loans, from shareholders' loans, or you into getting more credit because you are growing the business. But if your business is stable, you are operating normal, then you should be making money from your from your operating activities. And most importantly, whatever the figure that you calculate, the bottom line on the cash flow is supposed to balance with the cash in the bank in your balance sheet. So the cash in the cash flow should balance to the cash in the balance sheet. If the two are not talking to each other, we have a problem. It means your financial statements are not accurate, or they're not prepared the way they're supposed to have been prepared. So even on the preparation of the statement, it's a test. It tests the accuracy of the other numbers. When you're preparing the balance sheet, the cash flow tests the other number, the figures that you get from your balance sheet and your income statement from the accounting point of view. But also from the business point of view, cash flow will show you if you are making money or not. The income statement shows you if you are profitable or not. Remember, cash and profit are two different things. Okay, so cash is cash, it's money in the bank. Profit, it can be theoretical. It might look like you are making money, but to only find out that maybe you have other funny items in there, like adjustments, your depreciations, your revaluations, and all those things. They can make your income statement look better than it is. But the cash flow gives you the reality. It's a reality check. So even the funders, the investors, when they look at your financials, yes, they look at your income statement, the trends, the movement. Are you improving? They look at the balance sheet. Is the business healthy? Is it solvent? But they'll go to the income statement to see how liquid is your business. Are you generating cash? Are your movement between the two making sense between your current operations? You are making money from operations, or are you making money from financing activities, or you're making money from liabilities? Remember, you might think you are making money, you only find out that the money is coming from investment activities or it's coming from the financing. And if you are not in the business of financing or dealing with long-term investments, you're supposed to be making money from your operations. Okay. So I try to simplify this lesson as much as I can. Cash flow is a little bit of a complicated statement. Actually, if you look at the whole financials, the cash flow statement is a complicated statement on its own, but it gives you a cleaner and more information without the fat, without the filters. It gives you the status of the business. Is the business liquid? Is the business generating cash? Which is very important, because operating without cash or not generating cash, it might lead your business into distress. Yes, so that's the lesson on the cash flow. I hope it makes sense and you'll be able to read, prepare, and maybe present your cash flow in terms of what the components within the cash flow, what do they mean, and what do they mean to the business. I thank you.